Welcome. Sometimes the stock market can feel like you're trying to navigate a crazy jungle without a map. Well, today we're going to fix that. We are going to build, step by step, a really powerful, diversified investment portfolio using just 10 ETFs. And it's all designed for long-term growth right here in India. You ready to get started? Let's do it. Okay, so before we start building for the future, we have to take a quick look at the past, because the history of the Indian stock market holds this really powerful secret about creating wealth over the long term, and honestly, it's the key to our entire strategy today. So let's start with a quick question. I want you to picture this. The year is 1986. The Sensex just launched, and it's full of the 30 biggest, most powerful companies in India. Now, let's fast forward all the way to today. How many of those original 30 corporate giants do you think are still part of that elite club? Go on, take a guess. The answer? Just 4. That's it. Can you believe that? Only 4 of the original 30 made it? The other 26? Well, they were eventually replaced by newer, faster-growing companies. This is such a powerful lesson, right? It shows us that trying to pick individual stocks that will be winners for decades is almost impossible. It's like trying to catch lightning in a bottle. But here's where the magic happens. While those individual companies were coming and going, the market as a whole, well, it just went on an incredible journey. The Sensex jumped from around 500 points all the way back in 1986 to over 68,000 today. So what's the takeaway? It's simple. If you had just invested in the index itself, you would have automatically owned all the winners as they rotated in. You would have ridden this massive wave of growth without ever having to guess which company was next. Let's put some real numbers to this to see how powerful it is. Imagine someone invested just 1 lakh rupees into the Sensex way back in 1986. Any idea what that would be worth today? Over 1.5 crore rupees. That is the life-changing power of just tracking the market over the long run. And look, this isn't just some random theory. The legend himself, Warren Buffett, made a famous 10-year bet. He bet that a simple, low-cost S&P 500 index fund would beat a group of hand-picked, super expensive hedge funds. And guess who won? The index fund. It wasn't even close. The lesson here is so clear. For most of us, owning the market is a much smarter bet than trying to outsmart it. Okay, so we've established that owning the market is the way to go. But how? How do you actually do that? Well, the answer is a really simple but incredibly powerful tool, the exchange-traded fund, or as you know it, the ETF. This right here is the heart and soul of our strategy. It's called passive index investing. The best way to think about it is like this. Instead of trying to be a genius and pick the one horse that's going to win the race, you just bet on all the horses. You buy a fund that tracks an index like the Nifty 50, and you're no longer trying to beat the market, you're just moving with it. And the perfect vehicle for this strategy is an ETF. An ETF is basically a basket that holds all the stocks of an index. And the best part? You can buy and sell that entire basket on the stock exchange with a single click, just like you would with a single stock. It's the easiest way to own a small piece of hundreds of companies all at once. This slide really puts it all into perspective. On one hand, you have active investing. That's a high-effort, high-cost game of trying to outsmart everyone else. On the other hand, you have passive investing with ETFs. The goal isn't to beat the market, it's to match the market, but to do it effortlessly and, this is key, at a fraction of the cost. And those lower fees? That's more of your money working for you, compounding year after year. All right, enough theory. Let's get our hands dirty and actually start building our 10 ETF portfolio. And we're going to start by laying down a really strong foundation, right here in the Indian market. Our goal here is to own a piece of the entire Indian economy. So we'll start with the big, stable giants, the large caps. Then we'll add the faster-growing mid-caps. After that, we'll bring in the small caps for their even higher growth potential. And finally, we'll capture the rising stars, the companies that are on track to be the next generation of leaders. So here are our first 4 building blocks. With Nifty 50Bs, you get India's top 50 companies. With mid 150Bs, you get the next 150 mid-size powerhouses. Then an ETF like small 250Bs brings in 250 of the smaller, high-growth players. And finally, Junior Bs gets you the next 50, the companies that are literally knocking on the door of the Nifty 50. With just these 4, boom, you've covered the whole Indian stock market. Okay, our foundation in India is set. It's solid. Now it's time to get a little more creative. We're going to add some thematic rocket fuel to this portfolio, and at the same time, we're going to expand our horizons and go global. So, thematic ETFs are like these super focused spotlights. They let us zero in on very specific trends or sectors that we think have huge growth potential, all without having to guess which single company is going to be the winner. We're going to add two really interesting themes to our mix. First up is Mom 30. This is a momentum ETF. It basically just automatically invests in the 30 stocks that are trending upwards the hardest. It's a strategy of riding the hot hand. And second, a defense sector ETF to tap into India's rapidly growing defense industry. Two really distinct themes, both with incredible potential. So why should we limit ourselves to just one country? A truly strong portfolio has a global footprint. So our next stop is Asia's economic powerhouses, Hong Kong and China. So let's add two more ETFs to our global toolkit. HNSNGBEs gives you broad exposure to the whole Hong Kong market, which also includes many of China's biggest companies. And then we'll get more specific with MAHK Tech, which gives us a really concentrated dose of the most innovative tech companies in that whole region. All right, for our grand finale, we are going to the heart of global innovation, the U.S. technology market. This is where some of the biggest and boldest ideas on the planet come from, and we definitely want a piece of that action. And here they are, the last two pieces of our 10 ETF puzzle. With MAFANG, you get a front row seat to the absolute titans of U.S. tech. You know the names: Apple, Amazon, Google. But for a wider view, we'll also add MON 100, which gives you a slice of the 100 largest and most innovative companies on the NASDAQ exchange. And just like that, we've done it. We've built our 10 ETF powerhouse. So let's take a step back for a second and just admire the complete, totally diversified portfolio that we've just put together. This chart just lays it all out beautifully. We've built this really well-balanced portfolio. We've got a solid 40% core right here in India. And then we've complemented that with these powerful 20% chunks in US tech, the dynamic markets of China and Hong Kong, and our own high-growth Indian themes. It's a fantastic blend of geography and growth ideas. Now, there's one really important thing to keep in mind here. This portfolio is 100% stocks. That means it's all gas, no brakes. It is built for speed and long-term growth, which also means it comes with a higher level of risk. Notice we haven't included things like gold or bonds, which usually act as the shock absorbers in a portfolio. And that brings us to our final question for you. We've built a really powerful growth engine, right? But every fast car needs a good suspension system. So what assets do you think you could add to a portfolio like this to give it a smoother, more stable ride over time? It's something to think about. Keep exploring, keep learning, and we'll catch you in the next one.